Today we're talking about something that makes a lot of people nervous. It's market volatility. That's understandable considering you're seeing headlines like biggest drop in decades. When you see this, it may make you want to hit the brakes. But before you do so, stick around because we've got some great information today that will help you make sense of it all. We're covering market volatility, the surprising truth about why some of the best days in the market follow some of the worst days. Also, we'll talk about how emotions can quietly sabotage your retirement plan and how the outside noise can steer you off course when it comes to retirement. Hi, I'm Molly Nelson here with Clint Huntrods and Loren Merkle. They're both certified financial fiduciaries. Loren is a certified financial planner and Clint has a PhD. Loren, when it comes to market volatility and the emotions that people could feel, you completely understand.
Well, I don't know how you couldn't understand. I mean, on the surface, market volatility doesn't sound that bad. Where it really gets bad is when you log into your 401k plans, you log into your IRAs, you see the market go down and you see the impact that that has on your retirement savings. That's where the emotionality really comes into play. And it can make people make decisions about their finances, about their investment strategies, short term, that can really make a big negative impact on them long term. And that's the dangerous aspect of market volatility.
Yeah, and the goal today, guys, isn't to scare people. We want to empower people. The more you know about market volatility, how it works, what the bounce backs can be like, historically speaking, the more knowledge and power you have. So first, let's just look at what causes market volatility. There are a few things at play here. Clint, one of them is supply and demand.
Yeah, so if there are more investors out there looking to buy stocks than those interested in selling, that can drive the market up. The inverse can be true as well. And those things might not necessarily be dependent on any sort of specific economic conditions or events. That could just be investor sentiment and the impact of that.
Yeah, so what drives the market up and down? Supply and demand, investor sentiment, you mentioned that, Clint, economic events, company performance, and global events. And of course, in recent memory, Loren, there are a few global events that people remember very well.
Yeah, of course, we can't forget 2020 when we all went through COVID, and we can't forget 2001 when we went through 9/11. And the main theme about those types of events, or even corporate events, or any of these types of things that create market volatility, the number one thing that is present is uncertainty. Nobody really knows what this world is going to look like in 2021, in 2022, when we were in 2020. Nobody really knows what this world was going to look like in December of 2001, 2002, because of what happened in 9/11. So the markets react because the world reacts, and when there's uncertainty, the markets are going to have increased volatility, which is going to make your 401k plans, your IRAs, react even more.
Yeah, so when people feel like things are very tragic, again, global events like that, they may be wondering what's next. Well, here's kind of an eye-opening fact about market volatility. 24 of the 25 best days in the market over the last 20 years happen within just 1 month of the 25 worst days. And Clint, I've heard this before, the best days follow the worst days, and it's one of those things people say a lot, but I think what you're going to walk us through will really help us understand in numbers how it works.
Yeah, absolutely. Sometimes it's surprising to hear these stats that the best days in the market are not too far away from some of those worst days that occur. So one of the things that we have been able to find in a recent study by BlackRock is that the market returns following a 10% market decline the following 12 months are almost 16% historically. When there is a market bottom, so 10% or worse that the market is down, the recovery is actually even greater. So in some of those worst times, the bounce back, the recovery over the next 12 months was actually over 24%. So what you can find is that in those dark times when that market is down, it's really the importance of having a plan and staying the course. Because if you were to make a rash decision, that could have a really negative impact. You wouldn't be able to benefit from that market recovery. Here's another part of that study that BlackRock did, and it just shows over the last 20 years, what would happen if you did move out of the market in those dark times and missed some of those best trading days. So let's just first say over the last 20 years that you kept your money in the market, you invested $100,000, and then over that 20-year time frame, what you'd find is that $100,000 would appreciate to $717,000. That is if you put money in and you kept it in there for the duration of that 20-year time frame. But we mentioned that there can be some people that might decide, hey, I want to move some of my money out to cash or onto the sidelines because just things have gotten too difficult. And if they were to do that, And if they were to miss 5 of those best days in the market over that same 20-year time frame, they wouldn't have $717,000 at the end. They would have only $452,000. Still a great return over time, but they have missed out on a substantial amount of growth just by moving out of the market at an inopportune time. Now, this study continues to go on. If you missed the 10 best days in the market over that 20-year time frame, your $100,000 would have only grown to $328,000. If you missed 15 days, $250,000. If you missed 20 days, $197,000. And if you missed 25 of the best market days over this, thousands of days over this 20-year time frame, your $100,000 would have only grown up to $158,000. So this really underscores the importance of staying in the market, having that plan, and how impactful it could be if you were to move money out of the market and miss some of those most opportune days.
As I listened to all that information that you gave, Clint, there's 2 really positive things that I take away from that. One is market volatility actually equals opportunity. Volatility equals opportunity because when the markets go down, that can represent some really good strategic opportunities if you have that plan put together like what you said. The other positive note that I came away with from that information is market volatility is very predictable. Now, we don't always know what's going to cause market volatility, and we don't always know when we're going to come out of this market volatile event, but we have always come out of it. And if you take moves, you implement strategies while we're going through those different events, you can put yourself in a better place eventually when we do come out of it. And investing doesn't have to be all that difficult. The study that you just highlighted, basically, if you put your money in, you forgot about it completely over that time frame, you were in the best position than if you made some moves along the way. So investing itself doesn't have to be all that difficult. Where the complexity really comes into play is if you're a couple years away from retiring or you're in retirement and you have all these other moving parts that need to work in conjunction with your investment strategies. But that was really good news for a lot of people. Market volatility equals opportunity. Investing doesn't have to be all that hard, and market volatility is very predictable.
You heard Loren say market volatility can be an opportunity, but you might be wondering, what does that mean for me? Here's a great way to find out. It's a Retire Ready call. This is your opportunity to speak directly with a retirement planner about your retirement and the opportunities that you have. It's pretty easy to schedule. You just go to retirereadycall.com, find the calendar there, click on a date and time that works for you, and then you'll have a casual conversation with a retirement planner. We're going to continue talking about market volatility next. We take a look at a more recent example of how it could impact your retirement. Welcome back to Retiring Today. We talked about how missing just a few days in the market can dramatically affect your long-term returns. It's all about market volatility today. I'm here with Loren Merkle and Clint Huntrods. And Loren, it is 2025, and so far it has been quite a ride.
It is still 2025, and yes, it has been quite a ride. It seems like every hour something new is changing. We have a new administration in town. There's a lot of legislative conversation that's taken place, and the tariff talk, of course, is all over the place, and all of that creates uncertainty. In fact, this year, 2025, reminds me a lot of 2018. In so many different ways. 2018, increasing interest rate environment, the China trade war, China-U.S. trade war really kicked off, and volatility was at a near record high. If you guys remember, there were 2 market corrections in 2018. In the spring of 2018, the S&P 500 was down over 10%, and then in December alone of 2018, the S&P 500 was down over 10%. And I remember investor sentiment very clearly because there's a lot of conversations, a lot of concern, a lot of worry. And many people across the country, maybe you were one of them, went to cash in that time frame because that's what the news, that's what the media, that's what our friends were telling us. And we were looking at Warren Buffett. And Warren Buffett had billions of dollars in cash. And so a lot of people did rush to the sideline. And then what happened after that? 2019, 2020, 2021, 3 positive years in a row. Over that time frame, the S&P 500 was up over 70%. So those who went to cash, those who went to the sideline, potentially missed out on a 70% cumulative return over the next 3 years. And again, COVID was even in that time frame. and still a large return over that time frame. And the hardest part about making those decisions of let's take things off the market, let's go to the sideline, is when do you get back in? Because nobody's out there telling you now's the time to buy, now's the time to buy. Everybody's telling you now's the time to sell, but the hardest decision of those two decisions is when you get back in.
Clint, your last example looked at a 20-year time period. Let's just go back not too terribly long ago to April of 2025.
Yeah, so when we think back to April of 2025, we remember that the tariffs are really starting April 1st. Those announcements are made, and there's a really significant drop in the market. And if you just fast forward from April 1st, go out about a week, the market has kind of been in a free fall type of situation. And the news, if you were to read the news headlines, says things like, hopes wane for tariff concessions. There's stock carnage, is what the Wall Street Journal was saying. Stocks in turmoil. A lot of people say these tariffs won't be resolved overnight. And then what you're finding is in that first week of April, you are inching closer to realizing a full bear market. A bear market is when you're down 20% in the market, and right around that April 8th date, you're at 19%. So a lot of people are saying the bear market is here. We can just expect and anticipate that is what the future outlook is going to be. And what you'd find is that not a lot of people were excited probably that day, and some people were probably thinking about doing things. This is just going to be a continued free fall. This isn't going to be resolved soon. Maybe it makes sense to go to cash, get out of the market. And we've talked many times about, studies out there show that's not a good idea, but you could easily see how someone could be in that mind frame on April 8th. And if they did that, what they would miss is April 9th. And when we look at April 9th, we see that that was one of the best trading days since 2008. During that time, the Dow went up almost 8%. The S&P was up 9.5% in a single day, and the NASDAQ that day was up 12.2%. And so what you'd find is if you were to make rash decisions on April 8th, which is not unbelievable to expect that someone might be in that area, especially if they're nearing retirement, saying, I want to stop the bleeding. But then they would have missed April 9th, which goes to just underscore in a more recent example, that's 20-year study that we looked at, which is you need to stay in for the longer period of time and be proactive as you think about your investment strategies.
And that's why I said market volatility is actually very predictable. Sometimes what we hear, Clint, from people that we're talking about is, yeah, but this time it's different. Yeah, this time just feels different. And yes, every time we go through a market correction or a bear market, we go through it for a little bit different reason. But the one thing that is constant is eventually the market's going to come back, like it always has. And as long as you make the right moves during this time frame of volatility, you can benefit from the market volatility. And eventually when the market does come back, you are going to be able to prosper from that movement as well. The hardest part about all of this is just going through the uncertainty, because when we go through those time frames, the time frames that we talked about, COVID, 9/11, Black Monday, 1987, all of those time frames are not fun, right? We don't enjoy the pain, but just from a financial standpoint, it's actually a time to smile because of the opportunities that are present and how it can really positively impact your overall retirement plan.
And Loren, all of that does speaks to the emotions of what happens when you're watching this market volatility. What if this time is different? You've heard people say that. Should I move to cash just for now? Or I don't have time to make this back. And that's where people feel helpless. They feel helpless. They watch the market volatility. They see the headlines and they're like, I can't do anything about it. But that may not be the case.
Actually, you can do something about it. You can do a whole lot about it. We are sitting here talking about how people are feeling emotional and people are reacting. One of the things I am really proud about here at Merkle Retirement Planning is during this time frame this year, I only had 2 reactive conversations from the families that we work with, and both of those conversations were about strategies that they should actually be engaged in. One of the conversations, a family called me and he said, in our last review, we talked about this time coming up. Again, we didn't know why market was going to, but markets are always volatile. This time coming up, and you said at that point in time, if I have the appetite to increase my risk, I should increase my risk, right? Now's the time? Yes, now is the exact time. So our families are doing what they should be doing, implementing the strategies that are already present in their plan during these times because they do have a plan. And that is the key. Having a plan going into these types of uncertain events creates an opportunity for you, one, to see the bigger picture so you don't get caught up in the S&P 500's down 8% today, and you log into your 401k and you log into your IRA and the emotions take over. You have that plan, a written plan that is your guidepost, that is your roadmap to help you implement the strategies and come out on top. Within our plan, the Retire Secure Roadmap, there's 6 pillars. One is the lifestyle pillar. That's the fun stuff in retirement, right? That outlines all the things you're going to do spending your time on. And then the other 5 financial pillars are the way that you can accomplish that lifestyle pillar. So you need an income plan, a tax plan, a legacy plan, an investment plan, and a healthcare plan. All of those work together. Specifically highlighting the investment plan, one of the things that we do for the families and individuals we work with is we create what we call a recession-resistant portfolio. And what that means is very simple. When the market blows up, of course, your portfolio will be down, but it shouldn't be down anywhere like what the market is down. And that does a couple things. One is when the market eventually comes back up, you don't have this huge hole that you have to dig out of just to get back to even. But also, 2, is it helps the emotionality. So you don't get caught up in wanting to make decisions that you know inherently are going to hurt you long term, but you just can't help yourself because of the short-term pain. And that recession-resistant portfolio is something that we talk about a lot with the families and individuals we serve. And the important part is having that set up based on what you are trying to accomplish in your retirement, your risk appetite, all of your variables prior to going through these time frames, because once we go through these time frames and you don't have that in place, then it's too late.
Imagine watching the headlines and not worrying about your retirement. We have to put together a comprehensive plan, but you might be wondering, what is that? How does it work? What does it look like? You can talk directly with a retirement planner about how to build a comprehensive plan before market volatility hits. Schedule a Retire Ready call today at retirereadycall.com. We've got more to talk about when it comes to taking control of market volatility next. Welcome back to Retiring Today. Today's show is all about market volatility and helping you take control. I'm Molly Nelson here with Loren Merkle and Clint Huntrods. And Loren mentioned it. People don't have to sit back and watch the headlines necessarily and be concerned about retirement. The plans that we help families and individuals build, Clint, actually have action steps built into them for times just like this.
Yeah, Loren mentioned earlier, but somebody called in and said, hey, I've been preparing for this market drop. So if the market's down by 19%, example like we talked about earlier, if you were considering a Roth conversion and that makes sense as part of your tax plan, as we think about your overall comprehensive plan, then a great time to do that would be in a market downturn. So you're able to convert shares at a lower price, pay the tax bill. If you're going to do it this year at some point, the best time to do it could be in a market downturn. And then you're going to get that recovery on the Roth side, which is going to be tax-free growth. So sometimes our families, are thinking about when's go time, and they actually get excited about market downturns to take advantage of it.
Yeah, how many go time conversations do we get to have? Those are a lot of fun, especially in times when the market is uncertain, the world is uncertain, nobody really knows how it's going to end or when it's going to end. Having something in your plan like a go time strategy that you know is going to benefit you, that is extremely powerful from all sides. So the Roth conversion is a really powerful strategy. Another one is dollar cost averaging strategy. What we have always been taught over all of our lifetimes is buy low, sell high. The problem is that's a lot harder to do than what it is to say. But within our strategies, what we do is we incorporate safe money, not only to help from a risk standpoint, a protection standpoint, so when the market does drop, there's some safe money there we know is not going to be negatively impacted by the market. But wait, that's not all. When the market does drop, we can take a piece of that saved money that you didn't lose anything on, put that back into the market and buy low, like what we've always been taught, buy low, sell high. When the market is up, you can take some profits off the table, put it back into the safe money where you're still making money on the safe money and kind of reload for the next market event. On average, corrections happen every year. And we talked about 2018, a correction happened twice in that year. So on a frequent, consistent basis, you will have opportunities not only to protect yourself with that type of dollar cost averaging strategy, but to take advantage of it when we do go through these market corrections.
We talked about this outside noise. You can get a lot of advice from friends, neighbors, coworkers, people who have opinions, maybe even Warren Buffett. And when you said Warren Buffett was going to cash, Loren, I couldn't help but think, well, of course, Warren Buffett, he can go to cash. He's got plenty of it. But it's different than most people.
Well, that's interesting because I think the same thing. It's really interesting that we, as a country, as a world, used Warren Buffett as a barometer for that type of movement, because if Warren Buffett makes a mistake, which he does, just like all investors, what's it really matter to him? So instead of earning 20%, he's going to earn 10, or he's down 20. He is going to be just fine. Berkshire is going to be just fine. We are different, and you are different. When you're on the doorsteps of retirement and you are 2 years away from needing to use what you've taken a lifetime to save to furnish your lifestyle for the rest of your lifetime, the stakes are high. And that's why we say you get one shot to get it right when it comes to retirement planning. So yeah, it's nice to watch Warren and cheer him on and see what he's doing, but what he's doing is not necessarily what you should be doing.
Yeah, because no matter who it is, a friend, a coworker, even your brother or sister, their retirement is not your retirement. Quite frankly, they just have a lot of different nuances to them.
Yeah, and one of the things that we haven't mentioned a lot is, how do I get income from my investments in retirement? And that starts to underscore the importance of the shift from your accumulation and working years, where you're really thinking about that market growth and appreciation. Now in retirement, when we want to take income from those investments, that's where our investment portfolio needs to shift, and we need to be proactive in planning for those different distribution needs that you're going to have. We want to do that in advance so we're not making rash decisions. Recently talked with somebody who's getting to know us for the first time, and they had taken a very significant distribution out from their investment portfolio in March of 2025. And it really wasn't done with a lot of forethought or insight into, is there a better strategy? And so they sold equities to deliver that income. And I said, well, maybe your advisor wasn't expecting this. And they said, no, I do it every year. And instead of deciding, let's be more proactive, let's set aside a bucket that we know we can use for income, they were just taking a wholesale, we're going to stay in the market at a pretty high level and risk-wise. And this family was taking more risk that didn't really align with their income plan.
And that just highlights the need to have this comprehensive retirement plan that all works together, because within that little example, you demonstrated the necessity of an income plan. They knew they were going to take the distribution at this point last year. So why not have a plan in place, strategies in place to make sure they can still receive this money as they need and not have to sell depreciating assets? And it also coupled with the investment plan, right? All of these things matter. And that's why the comprehensive plan is so important. And the importance just continues to increase the closer you get to retirement and as you go through retirement.
I was also thinking about the tax bill they might have encountered with that kind of a distribution as well. You say comprehensive, I'm going to add personalized, because I think that's really where it's at. It's not what your coworker did. It's not what your neighbor did. It's not what Warren Buffett did. It's your retirement. So I think personalization is really the key. And one way to really drill down into your specific circumstance is to talk to a retirement planner. A Retire Ready call is the most personalized way to kind of get started.
That's one of my favorite aspects of the Retire Ready call, is because that call is all about you. What are you trying to accomplish? Do you know if you need to take a big distribution next month or at this point next year? How much money do you need to take out to have the lifestyle that you want in retirement? What are some really important tax planning strategies you should be looking at? What are some of the legacy plans that you can put into place to make sure when you pass away, whatever is left over goes to your loved ones and your charities in the most efficient way? It has to be personalized because it is your retirement. It's your life, it's your retirement, it's your joy that you are trying to find in this next phase of your life. Why not have a personal, customized retirement plan?
You just talked to somebody about market volatility.
Yeah, recently had a call with someone, and they had just experienced more volatility than they wanted. And one thing that we just talked about was, when was the last time you talked through how much investment risk you're taking and what could happen to your portfolio if we went through a downturn? And they really said, I've never done that. That I aligned my 401k, risk level when I got started with the company, and I really haven't evaluated it or looked at it since. And that's not what we want for families. We want to help you in being more proactive.
Well, that unknown adds to the uncertainty, which just adds to the volatility of their emotions.
You can schedule a Retire Ready call at retirereadycall.com. This is Retiring Today, and we thank you for watching.
Thank you for watching. If you enjoyed this, click here for another video. Be sure to subscribe to get more engaging retirement planning content.